Welcome to episode 4 of Bookkeeping for Small Business Owners. In previous episodes, we learned the concepts behind bookkeeping. And in this episode, we're going to actually begin to apply those concepts. We'll be going through 13 of the most common transactions you'll find in a small business. And yes, there's going to be plenty of things you haven't learned before, which is why this is a mainline episode and not a bonus episode. That said, my goal with this episode is to get you to start looking at transactions the same way a professional bookkeeper would look at them. So, starting there, how do professional bookkeepers look at transactions? Professional bookkeepers look at transactions through the lens of debits and credits. Your instinct will be to try and find which accounts are debited and which accounts are credited right away. For example, in episode 3, Cookies Galore received $200 in cash for their cookies. A professional bookkeeper looks at that and immediately sees it as debit cash $200 and credit sales revenue $200. In this episode, we'll cover transactions in the following format so that you can start thinking like a professional bookkeeper. I'll start by giving the transaction and all of its relevant details. Then I'll show you how a professional bookkeeper breaks it down, which is how I want you to start looking at transactions going forward. Then I'll explain anything necessary. First, hi, my name is Christian. I'm the owner and chief bookkeeper here at Vitality Bookkeeping. If you're interested in getting your books taken care of, I'd be happy to help. Just visit my website, vitalitybookkeeping.net. One last thing before we start. It's finally time to learn the difference between cash basis accounting and accrual basis accounting. That difference being timing. Under accrual basis, you record income when the money is earned, even if the money hasn't moved yet. Likewise, you record expenses when the money is owed, even if that money hasn't moved yet. The most typical example of this is when a business invoices someone or gets a bill. Under accrual, a business would record the invoice as income despite not receiving any money. Under accrual, a business would record that invoice as income despite not receiving any cash yet. And likewise, they would record any bills as expenses despite not paying out any money yet. Under a cash basis, you only record a transaction when the money actually moves. If you receive a bill or send an invoice, you don't record it at all in the bookkeeping. You wait until the invoice or bill is paid. In other words, you record transactions when the money is actually spent, or when cash actually moves, thus cash basis. To recap, accrual basis records transactions when they're earned, cash basis records transactions when the money moves. All right, back to the episode. A few notes about the transactions before we jump in. We will be using cash basis for these. All of the businesses and transactions in these examples are made up. And of course, I highly recommend that you pause and try to figure out the answer before I give it for these examples. All right, let's get started with an easy one. Transaction number 1. Luke's Consulting LLC receives $400 in cash for services provided. First, let's look at it the way a professional bookkeeper would. The acronym I'm about to go over is something I made up, but it's a good breakdown of a professional's thought process. So, the thought process is this. MAC. M-A-C. This stands for money, accounts, and then change. For every transaction, you look for the money, then you see what account goes with that money, and then you make the change. Let's try out MAC for this transaction. Luke's Consulting LLC receives $400 in cash for services provided. Money, $400. Accounts, cash and service revenue. Change. Debit cash, $400. Credit service revenue, $400. Pretty straightforward. The accounts are explicitly stated, cash in exchange for a service. We know that cash is on the left-hand side of the accounting equation, and thus has a debit balance. Likewise, service revenue adds to owner's equity, which is on the right side and has a credit balance. Therefore, the correct bookkeeping is debiting cash $400 and crediting service revenue $400. And don't worry, I won't over-explain the other transactions in this episode. That said, as with all learning, you'll start off slow, but the more you practice, the less thinking you'll need to do and the faster you'll get. And eventually, you'll feel like you can do transactions almost instantly. Transaction number 2. Bob's Cleaning Company purchases a new vacuum for $200. Let's use MAC. Money, $200. Accounts, equipment expense and cash. Change. Debit equipment expense, $200. Credit cash, $200. As you probably realized at this point, the most challenging part of recording transactions is determining what the correct accounts are. Just remember, think about where the account might land on the accounting equation. Crediting cash is easy here, but how do we know the vacuum is an equipment expense? This one's a little trickier. We know if a business owns something with lasting value, meaning it will last longer than a year, it should be considered an asset. Why is the vacuum an equipment expense if the vacuum seems like it will last more than a year? The answer is simple. If a potential asset is less than $2,500, per IRS rules, it can be expensed rather than turned into an asset. It's worth noting that you could also label it an asset because of its lasting value, but it's more common to simply expense items like this upfront under cash basis. We touched on this last episode when talking about fixed assets, if you remember. And one more thing, your business does need a written policy acknowledging the IRS's $2,500 limit. Therefore, all of that said, even though the vacuum has lasting value and is something the business owns, it can be expensed because it's worth less than $2,500. We call it an equipment expense because that's the most precise description of it. The name of the account doesn't need to be perfect, as long as it's reasonable. What needs to be perfect is where it fits on the accounting equation. There are plentiful resources online for helping people determine the correct account for a transaction. If you use one of these resources, just make sure it's trustworthy. Transaction number 3. A patron at a bar owes $40 on their tab. They pay it down $20. MAC. Money, $40 and $20. Accounts, cash and sales revenue. Change, debit cash $20 and credit sales revenue $20. Like we talked about earlier, under cash basis, we only record transactions when the money moves. We don't record anything about the $40 tab, only the $20 in income that was received for the patron paying down their tab. Transaction number 4. A therapist receives a $100 payment from a client's insurance company for a session completed in the past. MAC. Money, $100. Accounts, cash and service revenue. Change, debit cash, $100. Credit service revenue, $100. This transaction is a reimbursement by an insurance company. Even though the client didn't pay for the session themselves, the bookkeeping is similar to as if they had. Oftentimes there will be a copay. The copay and the reimbursement, of course, would be 2 separate transactions. Transaction number 5. A lawyer purchases toothpaste for his children for $8. MAC. Money, $8. Accounts, owner's draw into cash. Change, debit owner's draw $8 and credit cash $8. This is, of course, a little bit of a trick question. As we discussed in episode 3, only things that are both ordinary and necessary for a business can be expensed from the business. It's important for kids to have toothpaste, of course, but it's not necessary for the lawyer's business. This is a personal expense. So, what happens when you use business money for personal use? For tax purposes, this is considered a draw. It's a subtraction from owner's equity on the accounting equation that doesn't reduce taxes. In other words, a draw is the business owner taking some of their claim out of the business. Transaction number 6. A professional renews their license for $80 to continue legally working. MAC. Money, $80. Accounts, license expense and cash. Change, debit license expense $80, credit cash $80. And of course, a professional that requires a license to do business can expense that licensing fee. The next 4 transactions will be about the same business trip this person took. Typically, these transactions would happen sporadically over the course of the trip, but for the sake of simplicity, we'll say that each transaction type was paid all at once, just so that we can do this reasonably for the examples. Transaction number 7. Sarah runs a small marketing agency. She attends a 3-day marketing conference to improve her skills and network. Over the course of the trip, she spent $180 on meals, which she pays off all at once. MAC. Money, $180. Accounts, meal expense and cash. Change, debit meal expense $180, credit cash $180. As briefly mentioned in episode 3, meals are a very strict and unique expense for a business. A business can only write off a meal when that meal is explicitly to advance the business. This marketing conference works because Sarah can argue she would only acquire these marketing skills from this conference and that these skills are necessary for her success in business. If Sarah had just casually eaten with her friends, she wouldn't be able to write off the meal expense. Once a meal expense has met the strict standard, then it is subject to another limitation. That being that on her taxes, only 50% of the meal can be expensed. You'll notice though, we debited the entire $180 expense. In the bookkeeping, we record the full amount, so we know how much of an expense the meals were to her business specifically. During tax time, a CPA would look at the full amount spent on business meals and then take 50% of that for tax purposes. Transaction number 8. Sarah spent $900 on hotel rooms for the event and paid it off all at once. MAC. Money, $900. Accounts, lodging expense and cash. Change. Debit lodging expense, $900, and credit cash, $900. Lodging expense is a good catch-all for the various lodging and hotel costs you might acquire while traveling or on a business trip. Hotel is another expense that works, as long as you capture the general idea that this is an expense for staying somewhere outside of your normal home, for obviously explicitly business purposes. Transaction number 9. Sarah spends $200 for an airplane ticket to the event. Mac. Money, $200. Accounts, travel expense, and cash. Change. Debit travel expense, $200. Credit cash, $200. Typically, any costs associated with getting to the location can be expensed under travel expense. If she used her own vehicle and reimburses herself, the accounts would also be the same. Transaction number 10. Sarah purchases tickets to the event for $400. Mac. Money, $400. Accounts, professional development, and cash. Change. Debit professional development, $400, and credit cash, $400. The event itself is for professional development. So rather than a generic ticket expense or anything like that, we specifically label the purchase as professional development. Education and training expense would also be another good name for this. Transaction number 11. A construction company purchases a heavy-duty work truck for $50,000. Mac. Money, $50,000. Accounts, vehicles, and cash. Change. Debit vehicles, $50,000. Credit cash, $50,000. We've covered a number of expenses so far, but as we learned in episode 3, there are a handful of assets that can be purchased under cash basis. If you remember in transaction 2, we expensed the vacuum because although it had lasting value, its cost was under $2,500. The work truck in this example, though, is well over the $2,500 capitalization limit and should therefore be categorized as a fixed asset. Transaction number 12. A restaurant takes out a $100,000 loan with 5% interest. Mac. Money. $100,000. Accounts. Loans payable and cash. Change. Debit cash, $100,000. Credit loans payable, $100,000. Loan amounts are recorded at their full amounts as a liability. And the cash from the loan is, of course, recorded as cash. It's also common to label the loans based on how long they're going to last. For example, a short-term loan being under a year, or a long-term loan being a loan that'll last longer than a year. And of course, if it's a short-term loan, that would be considered a current liability. And if it's a long-term loan, that would be considered a long-term liability. Transaction number 13. The restaurant makes a $2,000 payment on their loan. $1,600 is towards principal and $400 is towards interest. Mac. Money. $2,000, $1,600, and $400. Accounts. Loans payable, interest expense, and cash. Change. Debit loans payable, $1,600. Debit interest expense, $400. Credit cash, $2,000. This is an example of a split transaction, meaning one cash transaction affects multiple accounts at the same time. In this case, the cash was used to pay down a loan and its accompanying interest. And just like that, that's episode 4. The main purpose of this episode was to have you start looking at transactions the way a professional bookkeeper would, specifically through the lens of the MAC acronym, which of course stands for Money, Accounts, Change. In addition to that, I wanted to cover 13 of some of the most common transactions you'll find in a small business. Up to now, we've learned the basics of bookkeeping and how to correctly record a transaction. In episode 5, which is the next episode, we'll learn where to log these transactions, how to officially keep track of how money flows through a business, and then what we do with that information. In other words, we'll finally learn what the books are in the word bookkeeping, and then what we do with those books. If you have anything on your mind or any questions, please leave a comment. If you're interested in getting your books taken care of, contact me at vitalitybookkeeping.net. Otherwise, thank you for watching, and I'll see you next episode.